Bloomberg Audio Studios.
Podcasts, radio, news.
I'm Stephen Carroll, and this is Here's Why, where we take one news story and explain it in just a few minutes with our experts here at Bloomberg.
Microsoft became the second company in the world today to hit a $4 trillion market cap alongside NVIDIA. This is after reporting earnings that beat Wall Street's expectations.
This AI revolution, it's in its next stage of growth. It's Goldilocks for tech.
These are trillion-dollar companies, and they're managing to post, for Meta, more than 20% growth, much ahead of expectations, and signaling it's going to be 25% potentially for the next quarter. Isn't that extraordinary? We have companies that valuable growing at that run rate.
It's been another bumper earnings season for the world's biggest tech firms. Silicon Valley seems to have shrugged off the economic uncertainty, reporting strong revenues and planning more massive spending on artificial intelligence. Investors have cheered most of the reports, but amid the optimism, some key market watchers are starting to voice concerns about whether the tech stock rally has gone too far. Here's why big tech's soaring valuations have some worried. Gina Martin Adams, Chief Equity Strategist at Bloomberg Intelligence, joins me now for more. First of all, Gina, big tech names doing well feels like a story that we've been telling for years. What's driving the strength in the sector right now?
So if you go back to the summer of 2024, I think it starts to sort of paint the picture for you as to what's really happening with tech. At that point in time, valuations were reaching new peak levels, but also earnings growth was peaking out. And we started to see earnings growth decelerate in the latter part of 2024 and early 2025. With that deceleration in earnings momentum inside the tech space, we started to see valuations rationalize a little bit. Came back down to around 20 times forward earnings, a little bit higher than 20 times forward earnings. But at the very least, we were sort of off of those what we thought were unsustainable peaks and experiencing some tech companies effectively growing into their valuation multiples. And then the tariff turmoil hit. And what became very clear in the second quarter is tech companies are still experiencing steady growth, while the rest of the market is experiencing a decelerating growth rate due to tariffs and uncertainty, economic uncertainty affiliated with tariffs. So the natural byproduct of that is capital flows right back to tech. Even though we're not seeing necessarily a reacceleration in that tech growth pace in order to drive that capital back, we're seeing damage emerge to the non-tech segments that wasn't anticipated at the start of this year, and that's creating this rotation that's favorable for tech.
But why is that, I suppose, a problem? If people are seeing strength in the companies and they're seeing something that's worth putting their money into it, why do we have warnings like from Michael Hartnett's team at Bank of America that they're worried now about the stretch of valuations?
Well, I think it's mostly because valuations have reached that new peak level. So the tech sector specifically, if you look at tech and communications together, which is kind of how we think about tech, you're looking at valuation multiples that are at all-time highs, even higher than they were in the peak in the market in 2021, even higher than they were in 2024. They've accelerated to levels that we're looking at near 30 times earnings. So very clearly what has happened is this concentration of capital has flooded into the space, absent any other perceived opportunities inside the rest of the S&P 500 for the most part. And even though the companies are earning very strongly and earning even better than analysts had anticipated, which is helping to create a short-term flight back to the segment, their earnings momentum is still decelerating. So what you have is a slower and slower pace of earnings growth that is continuing to emerge. These companies are facing higher and higher expectations, even though their earnings are decelerating, which creates a little bit of friction, creates a little bit of risk, because as earnings are decelerating, the companies are most vulnerable to a potential disappointment, right? We know that CapEx spending peaked last year. And we know that even though they're still spending at a very robust pace, we're still past that peak. The tech sector is really interesting because the cycle is really meaningful to driving relative performance typically. And I think this is what's creating the problem for strategists at this time is The cycle very clearly is not necessarily working in tech's favor because we had that peak in earnings growth and in sales growth. We are decelerating off that peak, even though the relative growth rate is stronger than the rest of the index. We are in that deceleration mode, and that creates a foggier environment for investing in tech than the environment, say, we were in 2023 and 2024, where earnings momentum was persistently improving. And that was a very clear case for why tech should lead. We're just in a messier market is the best way to describe it. It doesn't necessarily mean that all is lost and, you should just dump all of your tech exposure. Yeah. But it is a bit of a concerning market because valuations are so high and momentum is slowing.
What's the risk? Where should we be looking for the perspective to things to go wrong, essentially?
Yeah. The risk is, and this doesn't appear to be playing out in the short term. So I have to say, in the second quarter, for the most part, the companies have been able to satisfy expectations, have been able to suggest that growth rates are going to sustain themselves into the future. But the real risk is that that doesn't happen at some point in the next quarter or two, that a tech company or a few tech companies will say, oh, actually, we are seeing some real deceleration in demand from our customers, or we are seeing a deceleration in CapEx emerge. We've passed peak capital spending cycle, and the migration in the AI cycle from infrastructure spending cycle to the manifestation of AI in actual business process. Yeah. Maybe that doesn't go so smoothly, right? And we have to price different outcomes. I think that what is happening in tech right now is we're pricing close to ideal scenarios. And if anything emerges that is less than ideal, that makes the sector somewhat vulnerable to short-term weaknesses.
Do we have a good example of when this has happened in the past, perhaps in a different sector, that might give us an idea of what that could look like?
Yeah, the most representative example, and I hesitate to bring it up because it will, create a lot of hate mail, is probably the tech bubble.
Okay.
And I want to be very careful to clarify that, no bubble works out the same.
Sure.
Every mini bubble is different. This bubble is different in that there is actual earnings growth affiliated with these companies, which is naturally going to make it manifest. Any kind of deflation of that bubble will manifest a bit differently than the tech bubble did. But if you think back to the late 1990s, it again was all about we've got to invest for the future. The future is going to be magnificent. We're going to invest a tremendous amount of capital in infrastructure and laying pipe everywhere. This is now we're laying AI pipe everywhere, effectively, right? But nonetheless, when we moved from that initial infrastructure investment to the long-term benefits of having the internet and on everybody's desktop and ultimately everybody's phone, the run rates of growth were significantly slower than investors had priced over the long term. There were also quite a few companies at that point that weren't making any money and had nothing to do with tech that investors were still investing in. So it was a different scenario than it is today. But at its fundamentals, there are two things that are similar. The one big thing is that infrastructure is the investment, right? And when you're in the early stage investment on infrastructure, your growth pace is extraordinary. Investors start pricing in the prospects for that infrastructure to have meaningful impacts all the way down the chain, right through to the healthcare companies and consumer companies that are going to benefit from, at that point, having internet and now having generative AI. So the concern is, how much then do we price? And are we pricing too much growth and too rapid AI proliferation? Because, of course, the internet, as it emerged, became a very long-term driver of productivity. I think, you would argue it did ultimately have very positive long-term impacts. But we had priced such extraordinary circumstances, there was no way for the company fundamentals to be able to achieve those expectations in such a compressed period of time. They did achieve magnificent progress, but over a long period of time at slower growth rates than were priced. And that's very possibly what we're facing with AI now, is we're pricing extraordinary growth almost immediately. And we probably will get very meaningful change, but maybe it'll take a little while to actually manifest itself in real growth, real change to productivity, real economic conditions.
Okay, Gina, thank you very much. Gina Martin Adams, our Chief Equity Strategist at Bloomberg Intelligence. Thank you. For more explanations like this from our team of 3,000 journalists and analysts around the world, go to bloomberg.com/explainers. I'm Stephen Carroll. This is Here's Why. I'll be back next week with more. Thanks for listening.